My name's AJ Balama. I'm a registered investment advisor with Capital Securities Management, and I'm part of the team that manages your company's 401k plan. Today's topic is saving for retirement and why it's so important today more than ever. So there are three big factors that are creating this perfect storm for people today. The first being, Social Security may not exist in the same capacity as it does today. On their own website, they project the fund to be insolvent by 2037. As a younger investor, I'm not holding my breath for the government to carry me along in retirement. Secondly, people are living longer than they have in the past. You can see from this neat little chart that in the 1960s, the average life expectancy was around 70 years old. Today, in the US, it's closer to 79. Last but not least, costs are going up. It's a fact of life. The cost of inflation jacks up prices over time. For instance, did you know the price of gas in January 2002 was only $1.11? I'd sure take that today. Looking forward, food today costs the average American family about $585 a month. 15 years from now, it'll probably be closer to $911 a month. So with that in mind, the obvious follow-up question I get a lot is, AJ, how much do I need for retirement? This is a difficult question, and the answer greatly varies from person to person. I believe a good rule of thumb is 20 times your current annual income. So to put that in perspective, that means if you make $50,000 a year, you should have a full $1 million saved up to live comfortably in retirement. So at first glance, this figure looks completely unrealistic. $1 million? A lot of you are probably thinking I'm nuts and that this is impossible. But I assure you, it is very possible to achieve. You just have to be aggressive about saving. Let me show you how. I personally like to use the Dave Ramsey retirement calculator. It's pretty straightforward and easy to use. So we have to make a few assumptions to get this to work. 1, we have 30 years until retirement. 2, we currently have zero money saved. 3, we're putting away 15% of our salary. To go with our previous example of $50,000, that's $7,500 a year or $625 monthly. Lastly, we're assuming an 8% annualized rate of return. As you can see, that gives us $917,000, which is slightly short of the $1 million figure we needed. That being said, if you save for just one more year, you get to $999,000. If you start saving a full 5 years before that, 35 years retirement savings versus 30, you go well above and beyond that $1 million you need. Remember, this is also assuming you're not making any more in your life. You're only making that initial $50,000 a year forever, which is pretty unrealistic as you should expect to make more money over time. It's also important to point out that this is just a hypothetical illustration. Past performance cannot be used to predict future performance. I encourage you to play with the numbers yourself or reach out to me if you want to get a little bit more detail. So in this example, we used an 8% guaranteed annualized return. But as you know, you can't possibly get a guaranteed return of 8% every single year. The market moves in cycles. Sometimes it's up, and other times it's down. What's important to realize with your retirement investing is you don't need it today or tomorrow. You need it when you retire, which for many of you will be many years down the road. It's time that makes money, not timing. For instance, most of you remember the market crash in 2008. That was a bad year for a lot of people across the globe. But despite all the panic and the negative returns, the smart investors kept their money in the markets. You do not want to sell at a market low point if you can afford to hold on. If we actually break down the numbers, we see that if you invested $1,000 in the S&P 500 in the 30 years between 1986 and 2015, you had annual returns ranging from negative 37% to positive 38%. Over the 30 years, that $1,000 grew into $19,318. Again, I want to reiterate that accumulating wealth takes time. There are going to be ups and downs, but you have to block out the noise and just focus on your long-term goals. Remember, you probably don't need this money for a long while. If you want to ensure that you're properly allocated for a volatile market, feel free to reach out to us. That's what we're here for. So just to recap of everything we've gone over. 1. Investing in your own retirement is more important than ever. 2. A good rule of thumb is that you need 20 times your current annual income to sustain yourself in retirement. And 3, it's time that makes money, not timing. Remember to block out the distractions and focus on where you're going, not where you are.